CNBC leaked and exposed the hiding of true positions and synthetic shorts live on air. Today I want to talk about how recent events 100% prove exactly what was said live on CNBC and what's going to happen to these hedge funds over the next few weeks and the next few months. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So let's start by hearing exactly what was said live on CNBC.
Well, I'm going to say something that our management won't like, so if any of our bosses are listening, mute the volume. How does a firm amass such big positions synthetically? And I'll give you an extra order of tater tots if you throw in contracts for difference and or total return swaps into your answer.
Yeah.
Every quarter, we talk about these 13 Fs. We call it whale watching. We look at, the big funds, SEC filings on what they hold. I'm not saying they're not worth looking at, but here's the reality of the modern Wall Street. A lot of those positions might be fake positions or dummy positions to mask trades that are exactly the opposite, i.e., you own some of the actual equity, but you are synthetically short, or what I mentioned earlier, contracts for differences, which are swaps, ways to bet against things synthetically. You don't own anything. You're betting on a move. You can be paid up front. By the way, those are illegal in the United States.
Yeah. It's not something that hedge funds are new to. They have had to file 13Fs for, I think, decades at this point. And so they've figured out what happens when you disclose a certain type of position, a certain size of position. People catch on to it.
Well, when I was at CNBC, they taught us not to overcomplicate things on the air. So I'll just say this whole situation to me is like a string of, are you effing kidding me? What got Melvin Capital into trouble, I guess, is that they had to report ownership of put options, which effectively told the market we're massively short these stocks.
So I think this video was mostly talking about the Archegos collapse and also the Melvin Capital collapse as well. But over the last few weeks and the last few days specifically, we've seen more recent events that absolutely prove this. We've seen funds like AQR Capital Management, Cliff Asney's firm, holding 180,000 shares of AMC. But while they are holding shares, they're likely holding a massive synthetic short or total return swap position against AMC as well. Obviously, Cliff did state that his short position is only 12 basis points or 0.12% of his firm, but also said that AMC is everything wrong with what's going on right now. Therefore, I do think that many of these funds that are holding AMC shares, that are holding AMC call options like Citadel, Susquehanna and many others, do obviously have massive synthetic short positions against AMC and massive total return swap positions against AMC as well, and the CNBC interview absolutely proves it. And that is why, even though you can't see it on the 13F filings, there is many times that AMC float right now in synthetic shares and betting against AMC in total return swaps as well. But even though many times the float of AMC is betting against AMC right now, that's only a fairly small portion of the total cash invested into the stock market. AMC obviously has a market cap of around $10 billion. Even if there's $50 billion betting against AMC right now, or $100 billion, there's still $48+ trillion invested into the stock market. The majority of these funds are still massively long on the market, very irresponsibly long, using massive amounts of leverage to take their long positions, and it will come crashing down. We're seeing these leverage longs already coming crashing down in the crypto market with the recent liquidation of Three Arrows Capital, and we've also seen many hedge funds over the last few weeks and the last few months being liquidated as well. While we haven't yet seen any major hedge funds that are currently shorting AMC in a massive synthetic way being liquidated just yet, I think it's just around the corner and not too far away. And the reason why I say that is because the stock market is still crashing, and even these major banks and major institutions like Credit Suisse are showing major signs of default. When these defaults on major banks happen, it will cause major liquidations and major ripples across the entire stock market, and these hedge funds that are shorting AMC will get liquidated. So far, we're just one day closer every single day. And to prove just that, Gold Telegraph has tweeted saying the Federal Reserve has an estimated unrecognised mark-to-market loss of around $540 billion. Guys, if you didn't already know, from Moomoo's latest customer agreement, they officially state they do not sell your order flow. They state they do not lend out your securities, and they state they do not sell your orders to market makers like Citadel because they route their trades themselves with their own clearinghouse, Futo Incorporated, which also doesn't sell your orders. And therefore Moomoo is brilliant for buying those AMC shares. And guys, if you sign up to Moomoo right now using the link in the description below, you can currently get 10 free stocks worth up to a whopping $25,000 and a guaranteed free share of Lucid on top of that. So this relates to leverage loans to risky companies that the Fed has given out where they stand absolutely zero chance of recovering this debt. They haven't yet recognised the loss, even though these companies are defaulting, and there's an estimated unrecognised mark-to-market loss already of around $540 billion. And this is just the $540 billion that the Federal Reserve has lost, let alone the unrecognised losses that need to be recognised by these major banks like Credit Suisse, Bank of America, JP Morgan, and many others. Gold Telegraph also tweeted saying investment bankers in the United States and in Europe are bracing for potentially billions of dollars in total losses from leveraged buyouts that are struggling to offload corporate debt. Obviously, these leveraged and risky companies are struggling to raise additional cash and struggling to issue additional debt. These companies are trying to issue debt, bonds, and loans at rates of 10%, 14%, 15%, and even higher, and no one's snapping up the opportunity. I think some of these funds like BlackRock and Vanguard that do have the cash available to snap up tons of leveraged debt are realizing just how risky this debt actually is and how little chance they stand of getting the money back, and therefore they're not lending. These investment bankers that had record bonuses last year are now warning of economic hurricanes. Yes, the market is crashing, but this is only going to be amplified by these risky companies that are struggling to issue debt when they do go bankrupt, and it's also going to be amplified by these risky hedge funds that are taking irresponsible leveraged bets on the market. I also don't think it will be long until the next wave of the crash starts to happen. Deutsche Bank has just said that Wall Street earnings estimates are too high given the current recession expectations. Over the next few weeks, tons of tech companies are going to be issuing their Q2 earnings with disastrous results, and so far these companies are massively overestimating the cash they've generated and the profits that they've made. Gavin agreed with an extract from that Deutsche Bank report that says S&P 500 consensus estimates look far too high. Deutsche said estimates for 2023 are too high whether we get a hard landing or not. They're basically cutting their estimates for earnings per share, revenue and profits for tons and tons of companies inside the S&P 500. Reuters also reported similarly, saying concerns are growing that US corporate earnings are increasingly at risk from dizzying inflation, a strong dollar, and rising interest rates, complicating the outlook for investors already reeling from the S&P 500's bear market confirmation earlier this week. While second quarter profit growth forecasts have started to fall in recent weeks, weirdly enough, estimates for the third and fourth quarter and for all of 22 have held up or even increased. But obviously these companies are massively overestimating their earnings, obviously because the US, the UK, Europe and potentially the entire world is just about to officially go into a recession. And strategists worry those estimates are unlikely to hold up. Many expect more negative outlooks from US companies in the coming weeks, and said that guidance will then be reflected in consensus profit growth estimates. They've said estimates are too high, and you'll start to see them coming down as second quarter numbers come out and companies talk about what they're seeing. Falling profit expectations could spell more trouble for a market that's been pummeled by worries about how over-aggressive the Federal Reserve is responding to surging inflation that could hit growth. And Jim Cramer, although usually wrong, is saying the market could reach an investable bottom after analysts cut their earnings estimates. Obviously, when these analysts cut their ridiculous earning estimates, the market will continue to crash, and Jim Cramer thinks it could potentially reach a bottom, although I'm not too sure on the bottom being reached just yet. But I do think when these wild estimates are cut, we will start to see the next leg of the market crash unfold. CNBC's Jim Cramer on Thursday said that a possible upcoming slew of price estimate cuts from analysts could create a sell-off and an opportunity for investors to do some buying. Basically, as we start to see earnings being released over the next few weeks, many of these earnings are going to flop massively, causing the next wave of the market crash. We can also see the short's desperation because, as Corey tweeted, he said in the last 24 hours, the LA Times has tweeted out or retweeted the article about Adam Aron over 24 times in 24 hours. He then went on to post every single individual tweet and every single individual retweet of this LA Times hit piece article by the LA Times and by employees that work for the company. Clearly, they are trying to do absolutely everything they can to convince apes to sell their shares so they can try and cover their shorts before the market crashes, forcibly liquidating their entire funds. And to prove even more desperation and even more panic, Nate O'Brien has tweeted saying on YouTube he's had 6 figures worth of brand deals cancelled in the last 30 days. He said either companies are panicking or running out of money, probably a bit of both. Many of these major companies, many of these major tech companies that do currently advertise on YouTube are seeing the coming recession and they're cancelling all advertisement budgets over the entire platform. We've seen tons of crypto companies, tons of stock trading companies, and tons of tech companies in general cancelling not only their advertisements with creators, but all adverts on the YouTube platform and in general media or with Google Ads, for example. This is because these companies are panicking, they're running out of money, they know a recession is coming, they need to cut back on their spending, so they're starting to cut unnecessary things like marketing expenditure and starting to trim headcount where they can afford to. We've seen tons of companies like Tesla, Redfin, Compass, BlockFi, Coinbase, and many others already cutting 10 to 20% of their workforce and cutting their marketing budget because they know the recession is coming. When these major companies release their poor earnings for Q2 and the next wave of the market crash begins to unfold and more companies, more and more hedge funds, more and more crypto companies as well end up going bankrupt, we will see more and more crashing and we will see the AMC squeeze. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.